Good morning, everyone. I'm Axelle Blanchard, and I'm the European Policy Manager here at CDSB, the Climate Disclosure Standards Board. I will be your moderator today. We are very happy to have all of you joining us this morning for this CDSB webinar to speak and discuss the results of CDSB analysis of 2019 environmental disclosures by European companies under the Non-Financial Reporting Directive, or the NFRD. As most of you on the webinar know, CDSB published an extensive analysis of this disclosure in May 2020. We developed on that basis targeted briefings analyzing more in depth some of the key findings. These briefings are now being presented in a series of webinars, just like the one we're having this morning, where we'll be focusing on the state of risk disclosures. These events will pave the way towards our new and next analysis of 2020 environmental disclosures, which we will be releasing shortly on December 7th, ahead of the review of the NFRD expected next year. Before we start the discussions, let me just say a few housekeeping rules. The webinar is live streamed on social media. You can post all your questions on all these social media platforms, and we will be able to see and address them. The recording and the slides will be also sent to you afterwards in a follow-up emails. After these housekeeping rules, it's my pleasure to introduce you to our great speakers for this discussion this morning. First, we have Victor van Hoorn, Executive Director at the Eurosif, the European Sustainable Investment Forum. Warm welcome, Victor. You joined Eurosif in June 2020 after working as Head of Financial Services at Hoorn, the consultancy in Brussels. You graduated from both Maastricht and Georgetown universities, as well as Sciences Po in Paris, and you're also a lawyer admitted to the New York and the Amsterdam bar. You joined Eurosif, I think, at a very interesting time as the European Commission is moving towards a renewed sustainable finance strategy to define the contribution of the financial sector to the European Green Deal, following the Action Plan on Financing Sustainable Growth from 2018. In that context, investors will have to integrate but also disclose how they consider sustainability factors into their investment activities. We also have my colleague Gemma Clements with us this morning, Engagement and Capacity Building Manager at CDSB. Warm welcome, Gemma. Gemma supports technical and engagement work here at CDSB. She has worked on a number of projects, including the reporting exchange, but also various publications on non-financial reporting in Europe. Her current role is about managing the TCFD Knowledge Hub, but also developing CDSB's educational products and services. She also leads on the Beyond Disclosure program, supporting companies in their disclosure practice. She completed an MSc in Environment and Development from the London School of Economics and Political Science. So for this morning session, we'll hear first from Victor about how Eurosif and investors see the sustainable finance agenda moving forward amid numerous regulatory developments, before hearing from Gemma about the findings of CDSB analysis on risk disclosures. We'll then open the floor to all the questions you have for our speakers today. You can post your question on social media and on the different platforms, and we'll try to address as many of them. Please, Victor, the floor is yours.
Good morning, Axelle. Thank you very much for having invited me to speak today. It's a pleasure. Maybe let me give a few words about Eurosif. Eurosif was founded 19 years ago as a trade association located in Brussels. We represent the responsible and sustainable investors community and professionals. And really our aim from the beginning was to promote with policymakers at the EU level policies and regulations that would promote the uptake of those investment practices. As was discussing earlier this morning on another panel, I think maybe we can say to ourselves we've been successful, because the growth of assets under management in investment strategies taking environmental, social and governance factors into account has really exploded over the last couple of years, and particularly this year we've seen a great growth. That being said, there's still a lot on the regulatory and policymaking agenda, which I think we'll spend quite a bit of time this morning discussing. I think from our perspective, when we look at what what's been happening, And particularly one piece of legislation, of course, which the investment community is particularly focused on right now and implementing is the so-called Sustainable Finance Disclosures Regulation. And I think the best way to describe it for me is that it really pursues a dual purpose. One is that it's a relatively classic piece of investor protection legislation, where what you're trying to do is bring more transparency to the market, make sure that investors who buy investment funds are better informed, and it's more transparent how different investment funds and investment solutions are integrating those environmental, social, and governance factors in their processes, in their investment process, their asset allocation process. So really the classic transparency investor protection focus. I think what's interesting, which touches a bit on the EU Non-Financial Reporting Directive, is that this piece of regulation also introduces this idea of double materiality. This idea that it's not only around financial materiality and what, as an asset manager, you're doing for your clients as part of your fiduciary duty, delivering investment returns, but also what potentially the impact of your investment decisions are on broader sustainability indicators. So really going towards a direction where we will much better understand what the real world impact of those investment decisions are. So I think that's the big change. People more familiar with will have heard about things called like principal adverse impact indicators, which are currently in the process of being developed and finalized by the relevant European agencies tasked with drafting those additional rules. I think it's really, the way we look at it more medium to long term, that's really the direction of travel for this part of the investment management industry. I think we've seen a lot of, as I said, we've seen a lot of growth in the ESG assets under management, but coupled with that, there's always been the theme around greenwashing. Are those products actually delivering what they're promising to do? Can they evidence that? And I think really that's the direction of travel we're going in the future, particularly to ensure the robustness and credibility of that part of the industry, is that you will much more be expected in the mainstream to be able to evidence or at least provide information on the real world impact of those investment decisions, which means that it really abides by this idea of double materiality. What is the impact of ESG factors on the company versus also what is the impact of the company's operations on those sustainability factors at large? Which is an idea which was embedded from the onset in the EU Non-Financial Reporting Directive, which predates that other piece of legislation. So in that sense, they've aligned the disclosure regulation with the NFRD. So I think these are really the issues that we're dealing with right now to make sure that we get a framework that is robust enough to ensure the credibility of that industry. One of the key problems and the challenges is that these are regulatory frameworks that are very data intensive. You need a lot of data to be able to evidence that. And where I think when we look at what I hear from my members certainly is when we look at the market, you see a lot emergence of a lot of different alternative data sets for ESG factors. There's a flurry of data. There's really, I think, more than potentially people may be able to analyze. But the question is whether we got the right one, and that's clearly something that keeps coming back, is that we may not have the right data or decision useful data, nor is often that data audited or verified and gives a certain assurance to the user. So I think that's certainly things we'd be hoping to see in the future in the non-financial reporting framework as areas of improvement, which as far as we understand, the European Commission is very actively busy in doing that. But maybe I'll stop there as an introductory remarks, and if there's any further questions down the line.
Many thanks, Victor. I think that's a good picture of all the challenges and all the regulatory pieces coming together at a very fast pace at the moment in the EU. And I think it's a great introduction for the work we're trying to do at CDSB to provide guidance to the markets and explain how these regulatory requirements can be met through the relevant tools. What I'll just do before handing over to Gemma to present the findings we have on risk disclosure is to encourage our audience to post their question in the chat. And we'll be happy to address them. And I see they are starting to come. That's great. I will let the floor to Gemma to present the findings, and we'll be back to answer your questions shortly after that. Thank you, Gemma. The floor is yours.
Thank you, Axelle, and some really interesting points from Victor. I wish that I could address some of those points, especially around kind of what decision useful data looks like. But I think as a market, we're still trying to kind of figure that out. So I don't know if I'm going to be able to answer that particular question from our analysis. But what I want to do today is kind of give you a bit of an update and some information about a review that we did, as Axelle mentioned. We did a review. Sorry, next slide. We did a review in May 2020, so earlier this year, looking at the state of reporting in the EU. We looked at the 2019 reports of Europe's 50 largest companies, and we reviewed them against a qualitative and quantitative set of questions. Specifically focusing on the content categories of the Non-Financial Reporting Directive and the core elements of the TCFD. So we really wanted to kind of understand, who's reporting, how are they reporting, and what the quality of reporting was. So we decided to keep our sample at 50 at this stage, just so that we could really kind of get a grasp of the quality of reporting. On the screen, you can see that there are some of the key strengths and weaknesses that we observed from the reviews. And in particular, we're focusing our briefings on the weaknesses. We wanted to focus in on those and kind of delve into a little bit of detail about perhaps why these were particularly troublesome or challenging for companies to disclose, and kind of the direction that we're seeing those going in. Just to kind of give you a heads up, this report was published in May, and we're actually leading up to the next report, which will be published in December, I think December the 7th, where we kind of are continuing to look at the next set of reports, see how disclosure has improved, and so kind of keep a look at that. We will provide you a link so you can attend the next webinar of that launch. Next slide, please. So to give you a bit of an overview of the aims of the report before I dig into the risk disclosure specifically, in terms of the purpose, there were kind of really three main aims. The first and the second is kind of to provide evidence on the state of environmental and climate-related disclosure under the EU non-financial reporting, and to consider the effectiveness of the directive, especially in relation to its purpose in providing investors and wider stakeholders with relevant, consistent, and decision-useful disclosures. And as part of that, we are also looking to support companies in enhancing their disclosure by identifying areas of good practice and some kind of helpful top tips for disclosure. We provide this support through the report, so we have at the end of each section some recommendations for both policymakers and for companies, but we also provide one-on-one feedback to the companies in our sample. Next slide, please. So the review covered 50 companies, as I said, across 8 jurisdictions and 10 sectors. The next review, obviously, we don't like to mention Brexit, but because of that, the next review, we haven't included UK companies. But for this review that we did back in May, we did. And we also looked at companies from across different sectors. These companies have a combined market capitalization of $4.3 trillion. So it represents a sizable chunk of the European economy. And we recognize that the NFRD covers other non-financial information like social and employment matters, but we really focused in on environmental and climate disclosure under the content categories of the directive. So that's the business model, policy and due diligence, outcomes, principal risks, KPIs, as well as the 4 core elements of the TCFD recommendations. Just on the last point, we primarily looked at mainstream report as the primary disclosure, but where companies did provide information in, for example, a sustainability report or in a non-financial statement, we also considered those as long as they were signposted and connected and referenced from the mainstream report. What we found is that a lot of companies, there were loads of different approaches. Some companies provided us with one report and using an integrated approach, whereas I think the biggest one, or the most that I reviewed, I looked at a company who had 5 different documents where the information was spread across the mainstream report, annual report, a non-financial statement, and other kind of policy statements that had information in it as well. Next slide, please. So focusing on risks, because that's the topic of today, we found that principal risks was an area where specific challenges were identified. At a basic level, 90% of companies did disclose at least one principal risk relating to climate or environmental matters, with about 54% considering both transition and physical risks as they're defined by the TCFD. However, the description of these risks and the quality of the descriptions varied across all of them. So, for example, some disclosures provided just a list of the risks with very little detail about the nature, the context, or the impact of these risks. Where there were descriptions of impacts, some of these, there were a few that were quite good, but most of them were often very generic and lacked entity or content specific information or any form of quantification. There was also an observed issue with clarity and the distinction between risks related to the impact on the business and risks related to the impact by the business. And I'm going to cover this point in a little bit more detail on the next slide. But we also found, no, go back one slide, sorry, I haven't quite finished. But we also found that considering time horizons, only 6% of companies specified how the identified risk would impact the business over the short, medium, and long term. So we looked at both how and whether companies used different time horizons in their analysis, and whether they defined what those time horizons were, and also whether they provided us information about when they envisaged these risks would manifest. And as only 6% provided us any information about time horizons. And overall, while risk is a key area of focus under both the Non-Financial Reporting Directive and the TCFD, it's pretty clear that efforts are needed to improve risk disclosure. In fact, principal risks disclosures under the NFRD were often addressed separately to TCFD disclosures, and sometimes even separately from principal financial risk disclosures. So there were 3 different disclosures, and this could sometimes lead to duplication and some confusion and inconsistency in the reporting. Without clearly articulating how environmental and climate risks are integrated into wider business processes, investors are unable to discern how these risks are used to inform company decision making and how significant they are considered to be relative to other business risks. So we found that was something that really needs additional work. So if we go on to the next slide, and I'm going to focus in a bit more on this idea of different risk perspectives and how this kind of manifests in the disclosures, how this is presented in the disclosures. There are generally 2 perspectives on risk disclosure. And when we are reviewing corporate disclosures, it's fundamental to understand which one is being considered and which one is being disclosed. And there was sometimes a bit of confusion about the 2. So there is a clear distinction between risks and impacts to the business, which might include physical or transition risks that are defined by the TCFD. And these are external factors that might have significant impact on the company's ability to create value and to operate. This perspective on risk differs from the risks and impacts by the business. Now, this might include risks related to water abstraction or emissions. And although they are distinct, there is some overlap. So these impacts might also lead to risks to the business. So, for example, a good example of that is greenhouse gas emissions. That's information that describes the impact the business has on the environment. But then when you apply understanding of future greenhouse gas emission regulations, or when you consider kind of the impact that high emissions companies has on reputation, those then can become risks to the business. Under the current directive, companies are expected to consider both these perspectives where relevant and where proportionate. So companies are expected to disclose the information that describes these risks as they may impact the company. But as important as these descriptions, there's also an expectation that the disclosures should include a description of the risk management processes. So this should include the processes that companies use to identify, manage, and mitigate these risks, so as to demonstrate the significance of the risk and how that's managed. So if you're looking at both risk perspectives, there are going to be different internal processes that are applied. And where appropriate, the disclosure should distinguish between whether risks are incorporated into enterprise risk management processes and where there are separate processes being used. So to give you an example of what I mean, some companies, when they're describing how they understand the significance of risk and how they establish what principal or material ESG risks they have, they often use the materiality assessment prescribed by GRI to establish what material sustainability risks are based on stakeholder engagement. Now, this process may cover both elements, but it does not kind of give us any indication of whether the risks are incorporated into the company-wide enterprise risk management process. So when you're thinking about what risk you're disclosing, think about which perspective you're taking, and that will then kind of help you understand what information and what processes you need to describe. Next slide, please. So at the end of our briefing, we give kind of 3 top tips and 3 kind of things that companies can think about in order to enhance their disclosure. And I'm going to run through these quite quickly because I think they're quite self-evident. So the first one is to provide business-specific examples of how the identified risk may impact the organization. So this is to provide entity or content-specific descriptions of the impact to the company. It may be a detailed narrative about what these impacts will be, or for companies who are further along and a little bit more advanced, they may be able to quantify these impacts. The second one is that companies need to clearly state the time horizons over which the risks have been considered. And to enhance these disclosures, companies should provide the horizons used in the risk management process, including whether when these risks are likely to materialize. And this is something that the TCFD very much advocate for. And the third thing is to link risks and the management of the risks to the policy, due diligence, and outcomes. So one of the things that I love about the Non-Financial Reporting Directive is even though you have the 5 kind of content, core content elements, they are also interconnected. It's very difficult, we find, to produce one set of disclosure without connecting it to the others. So great disclosure we've seen describes the risk and then demonstrates how those risks inform policies and then how the outcomes kind of feed back in a loop and are used to mitigate those risks. Just a few more slides from me. The next slide. As part of the policy, as part of the briefing, we also provide some points for policymakers to help clarify certain elements in order to improve disclosure. So this includes removing exemption, allowing non-financial statements to be reported outside the mainstream report. What we find is where there are multiple reports, as I said before, there's often inconsistency and confusion about where the information is, and having all this information in an integrated report using integrated thinking, really gives a great story, gives the company a great opportunity to tell their story and to describe everything quite clearly. The second one, to review the principal risk requirements and to make sure that they are emphasizing that the impact should be that companies need to disclose information about the impact to the business as well as the impact by the business. To incorporate climate into the wording of the directive, and I think this will help demonstrate the alignment between the Non-Financial Reporting Directive and the TCFD recommendations, which leads on to the fourth one, which is to embed the TCFD recommendations fully. At the moment, the TCFD recommendations are part of the non-binding guidelines that were released last year, and we're hoping that perhaps going forward they will be more clearly connected in the directive itself. Next slide, please. So as I mentioned before, we have got the next review. So we've looked at the next set of reports. We're considering kind of how reporting has improved year on year. In fact, this is the third iteration of this review that we've published. And this publication will be out on the 7th of December. And as I said, we will share a link with you so that you can register for that event. We are also offering companies some feedback. So if you were part of the sample, we've already reviewed your report, so you can kind of get in contact and we'll share with you the specific information that we found about your report. And in particular, with this next report, we are looking at the connections with the TCFD and how the non-binding guidelines were applied, as this was the first year that they were introduced. Next slide. And as we mentioned at the very beginning, this is just one briefing as part of a series of briefings. I think Axelle, you can tell us. I think the next briefing webinar might be tomorrow. But I will let you tell us about the next one, and that one's on the countries.
To be precise, on the 27th of November, but I'll refer to it at the end of the briefing.
Brilliant.
Today.
Next slide. And I promise you this is definitely the last slide for me. So I just wanted to kind of quickly introduce our Enhanced Reporting Europe campaign, our program. And even if you were a company who weren't part of the top 50 sample, we have been very kindly funded by the EU Life project program, and they've funded us to be able to provide feedback to companies even outside of this review. So if you are a company in Europe and you want to get some feedback about how you've done and how your reporting is aligned to the Non-Financial Reporting Directive and the TCFD recommendations, do get in touch with us. And that's the end of my presentation.
Thanks a lot, Gemma. And hopefully these briefings, the analysis and the recommendation will be useful for EU policymakers going forward and in the upcoming initiatives for next year. So I'm looking at the questions we're getting from the audience. Maybe let me go first to you, Victor, and also referring back to your introductory remarks. What I have taken from them, maybe two main points around the whole policy coherence discussion and how to make the different regulatory requirements work together, especially those on investors and those on companies, even though investors might also be covered by both, especially the SFDR, the Sustainable Finance Disclosure Regulation you mentioned, and the NFRD. And also the second point you mentioned in your intervention, and you have we have a few questions about that in the chat, so I'll address this point. Is the data question, where to get the data from? So maybe the question we have are about, how we can access trusted sources of ESG data, how they are publicly available, and I guess what could be interesting for our audience is to get a sense of how your members are actually looking and using the relevant data in their day-to-day activities, and also to meet these regulatory requirements. Over to you, Victor.
Thanks, Axelle. There's quite a lot to unpack there, and a lot of different sub-questions and strands. I think you're maybe taking it from the perspective of regulatory coherence. I think that's very important. What we've seen is initiatives coming in at a different time, asking slightly different information. And I think now we're at the stage where particularly the next year, the review of the Non-Financial Reporting Directive may be an excellent opportunity to make sure that both the investors under the SFDR, but as well the one we haven't mentioned yet, but is the EU Taxonomy regulation as well, which is also a piece of legislation that's very data intensive when it comes to the process of identifying economic activities that are deemed sustainable from a climate mitigation and climate adaptation perspective. So I think the NFRD will be a great opportunity to get some coherence across those pieces of legislation where investors can get the information from companies. I think we have to be cognizant that the challenge for companies will be big. So it's not something that will be happening from year one. I think it's going to be probably an evolutionary process, which means it's also going to be an evolutionary process around the quality of disclosures by investors, asset managers, asset owners, reliant on that data. I think it's going to be, it's going to take time, and we're going to hopefully see some improvement on the quality. But it's very important because one of the things I didn't mention yet in my introductory remark, but is what's going to be very exciting development is in 2022. Under the SFDR regulation, all investment products that are in the scope of that piece of legislation will have to report versus the same tool, which is the EU Taxonomy. So they'll have to report the alignment of their portfolio versus the EU Taxonomy, which will finally allow us to compare all those ESG products versus what they say in their documentation, what they state are their ambitions versus how it's translated actually in the construction of their investment portfolio. So I think that will be interesting. But again, we come back to the need for a lot more data to back that up. And I think what's interesting as well is that we're venturing at a time now with the TCFD, with the NFRD, with focus on climate, where what's critical is climate scenarios. It's that's I think a critical piece of the equation to get right. And what's interesting is that for the first time, you're actually asking an entire community that's based a lot of their models on historic data to now say, well, actually, we're not longer going to base it on historical data. We're now asking you to take a long gaze into the future, whether it's 5 years, 10 years, 30 years, 50 years. Which requires a change of perspective, a change of mindset. So I mean, that takes time. It's absolutely necessary that it happens, but it will take time.
And yes, maybe thanks for mentioning the taxonomy, because that's definitely on everyone's minds these days. And actually the ESMA is currently having a public consultation on the shape of the taxonomy disclosures and how, and it will be interesting to see how they can be intertwined with the NFRD, because you already have indeed a clear link between the NFRD and the taxonomy. But maybe I can ask a broad question. Do you see the taxonomy, I guess it's a little bit of both, but do you see it as a challenge or really an opportunity for investors going forward?
Well, I think it's quite right. It's a challenge and opportunity. I mean, it will be a challenge from an operational perspective when it comes to getting the data, building the IT systems, and that allow you to then report to your customers versus the versus the portfolio and how it aligns to the taxonomy. Equally, it will be the same when we in the future look at portfolio alignment from a climate perspective, where we're trying to see which investment portfolios are financing what level of degrees of a world economy. I think that's the same thing. We'll see those same challenges. But I think it's also an opportunity in the sense that I think there's definitely in the asset management industry a number of front runners. So the players that have been doing that for years have very developed teams, very developed data sets, methodologies. So I think will be helpful. What is really helpful is, I think, is for a lot of the firms that maybe had not such a long track record or investments in the ESG space, that the taxonomy allows you to at least have a system which allows you to identify economic activities, which I think there's fair to say there's a broad consensus that those activities are the ones that are going to help us achieve, our 2050 objectives of carbon neutrality, and also, soon to be enshrined in the European climate law, that objective for 2050, so an official objective for the EU as a whole. So I think in that sense, it definitely is an opportunity. One of the things that flagged, though, we think definitely an area of future work, and that applies both to the taxonomy as well as the disclosure regulation, is that a lot of onus is put on the so-called do no significant harm principle. That is a principle that underpins both pieces of regulation, which is really the idea that you can finance an activity or invest in an activity achieving a particular environmental objective, say it's climate mitigation, but it should, as far as possible, not create significant harm to other objectives. And that, however, at this stage is not very well defined, which means that the incidental evidence we get from the investment community up to now is that there is a huge disparity in the way firms are going to be dealing with that in terms of due diligence, in terms of approach, in terms of decision making. So I think there will probably be a bit of further work needed there to ensure that we achieve that comparability across investment products in the market.
Yeah, many thanks, Victor. I think you covered a lot of the challenges for investor going forward. I just saw a question, and I think it's a good one, maybe, and a good moment for me to turn to Gemma. We just had a question, and Victor, you mentioned scenario analysis within the TCFD recommendations. We just got a question about how TCFD provides standard scenario for reporters. And saying that without such scenario, it's very difficult for investors to compare across companies. So do you want to address that question, Gemma? I think that's a question we get a lot these days from and you're interacting much more with me with companies, so I'll leave you answer that one.
Thanks, Axelle. Yes, I mean, to answer your question directly, do we see the TCFD providing standard scenarios? No, I don't think we should expect that from the TCFD. They have recently, so it's 2 weeks ago when they published their status report, they also provided additional guidance on scenarios. There are still a lot of kind of technical issues around the scenarios that are used, whether they're sector specific, whether they're kind of regionally specific. We've got transition specific ones, physical risk. Some of them even kind of delve into some of those topics in a little bit more detail. And I think we are seeing an evolution of scenario analysis. It's not a new tool. Scenario analysis is actually been around for many years. Not all sectors, not all companies would have been using it, but we're certainly seeing an evolution of it over the last few years. And we're starting to see the methodologies that are being developed becoming more enhanced. They're definitely developing at a quite a fast rate. But at the moment, I would say that kind of the best work that's going on at the moment is definitely around sector-specific kind of guidance. There's some great work by the UNEP-FI looking at financial institutions, banks, and they've got their banks pilot study, they've got their insurance pilot study, and their asset manager pilot study, and they're really delving into the scenarios in a bit more detail and trying to figure out exactly how they can standardize that approach. But I think kind of if you're looking for a a scenario that is widely applied. There are some out there. So you have the IPCC's, I can't remember the number now. I will find it, and I will respond to you directly, Shara, in LinkedIn. But there is IPCC scenarios looking at physical risk, and then you have organisations like 2 Degrees Initiative looking at transition risk, specifically for asset managers as well. So there are methodologies out there that are starting to kind of build a standardised approach, but not just yet, and certainly not from the TCFD.
Thank you, Gemma. And I think we'll still see. And I mean, I don't want to. I can tell our audience that our next analysis that we'll unveil shortly will definitely touch upon the weaknesses of scenario analysis, disclosure, and risk in general, which remains in the top weaknesses in terms of disclosures in the companies we reviewed over the years. Maybe an additional. Oh, sorry, Victor, I didn't ask if you wanted to add something. Go ahead.
No, but I think it's an interesting question, because there seems to be an assumption that either companies or policymakers will automatically deliver you with a set of scenarios. I think what I'm certainly picking up from some of my most advanced members in this space is that some of the large investors are going to develop their own scenarios. And I think because with scenarios, like with any scenario in any model, it's always depending on the assumptions that you based your model on. And I think at some point, we're now in the process. I think we've mentioned IPCC. I think there's one from the UNPRI inevitable policy response. The IEA had a 2 degree scenario. So there's a lot of work happening. But I think in the end, we'll end up, I think, pretty soon a question of how credible those scenarios are, and people will start testing the assumptions about the credibility. So I think a number of investors I'm aware of are decided that they will also develop their own scenarios where they feel that the assumptions underpinning them are credible from their perspective. So I think that's
Yeah, and kind of furthering that, Victor, I think that's exactly right. And I think in terms of the disclosure, what we would expect to see from companies' disclosure, certainly we want to see what those assumptions are. And I think at this point, and I think a lot of companies get quite nervous about scenario analysis. It's definitely not meant to be a future prediction. We don't expect everyone to have a crystal ball and to be kind of figuring out exactly what's going to happen in the future, but because of that, we wouldn't expect you to be able to provide information about what your business will definitely look like in the future. It's about the different pathways, and what we mainly want to see, especially at the beginning stages, is what are the pathways, what are those assumptions that you're placing in those scenarios. So you have to, when you're disclosing information, and as Axelle mentioned, scenario analysis is also not just something that we've highlighted as an area of weakness in a lot of disclosures. It's something that the TCFD in their status report a couple of weeks ago also pulled out as somewhere that's got there's still a huge gap in terms of the quality of the disclosure. And I think at the first step, companies need to think about disclosing the methodologies that they use, the assumptions that they use, kind of, and how they're, if you don't want to quantify the information just yet, tell us how you're doing that process. Tell us how you're doing that assessment, and that can give investors the confidence that you are at least kind of putting together some sort of internal plan at the very first stage. Yeah.
No, I can only agree with your last comment. I think the assumptions already will give a lot of information to investors about how credibly or how seriously a company is dealing with the issue, and whether investors feel that a company is in control or on top of that process.
Well, many thanks for this interesting conversation around scenario analysis. I'm sure we'll hear much more of these in the upcoming months. I think we could go on for an hour or even more on this fascinating topic. But I think today we really addressed both the challenges and opportunities around and in the sustainable finance agenda in general, I would say, and we have touched upon many ways forward for both I guess, on a company perspective, but also for policymakers in the upcoming legislative initiative that they will take. And a lot of them are happening, in fact, just after the break in January. So let me just thank both of you for your contribution this morning. Also, all of our audience for their questions. And yeah, no doubt disclosure reporting will remain high on the policy agenda in the upcoming months. At CDSB, we'll try and we'll keep the debate going. We have lots of webinars and events that we already touched upon earlier in this session, but on the 27th of November, we'll have another webinar on a briefing we did with a cross-country perspective this time. So looking at French, German, and Polish companies and how they are implementing the NFRD requirements. On the screen, you can see some more details around the launch of our next analysis of 2020 environmental disclosures. And we have the pleasure to welcome both the European Commissioner, Mairead McGuinness, as well as Patrick de Gambourg, Chair of the EFRAG Project Task Force on preparatory work for the elaboration of possible EU non-financial reporting standards. Yes, I always think that's a very long name, but it's a very important task force to follow in the upcoming months. We hope you can also join us for these interesting discussions. Many thanks again for joining us this morning, and have all a very great day. Bye-bye. Thanks, Victor. Thanks, Gemma. Have a good day.
Have a good day. Bye-bye.
Thank you.